Hey there, if you follow us on our YouTube channel, Homes for Sale in Athens GA, you know my name's Scott Talley. I'm the owner broker here at 5Market Realty. You may already follow us, or possibly you've searched what is a 1031 Tax Deferred Exchange. And if you have, you come to the right place because we're going to cover that. We're going to explain what this is in investment real estate, how it relates to rental properties. We also provide market updates to people interested in Athens area real estate, videos on our new listings. So if you're interested in anything related to Athens area real estate or investment property in this area, be sure to click subscribe. But we're going to talk about the 1031 exchange. Now, I did a video on this 4 years ago that was done as a webinar. It was about 36 minutes long, and we're going to do a little truncated version of that so you can get this information quicker and not have to dedicate quite so much time. We will have a tag in here that will link you to that older video, but this is going to be a little better version, a little bit more to the point, and give you some of the information you're going to need to avoid the pitfalls of a 1031 tax deferred exchange when trying to pull one off. Now, what are we going to cover? First of all, what is a 1031 tax deferred exchange? We're going to explain that to you. Why is it helpful? Then we're going to make sure you understand tax liability and what capital gains tax is, the general rules and basics of a 1031. Then, of course, understand how to sell and to buy a 1031 tax deferred exchange, how to successfully get that done. There is a process to it. There are a lot of mistakes people can accidentally make. We're going to try to guide you through that. And then hopefully, if you need help in the future, you can reach out to somebody here at our company or myself at 5Market Realty. Now, what is a tax deferred exchange? Quickly, we're going to give you the definition. It's the like exchange of one property for another done by adhering and following the guidelines set out by the IRS Code 1031. The exchange must be of like kind and in the United States. So the number 1031 comes from that IRS code or the tax code. But the simple version is you're selling one investment property in order to buy another investment property without paying long-term capital gains tax right now. Here's what I want you to note. A lot of people call it a tax-free exchange. It is not tax-free. It is tax deferred. You are deferring those taxes. They're not free. The bill will come due one day. Overall, the tax code outlines a tax rule that may allow you to sell, then reinvest your gain back into more investment property. This is an important tool to help you expand your portfolio in real estate and to plan for retirement. There are many steps and mistakes you can make when trying to do a 1031. I'm going to help you go through these steps right here in this presentation that we put together. Again, why is it helpful? Well, number one, you can defer your capital gains tax. Two, you can sell your investment real estate for a profit. You can reinvest the gains in another property. You're going to grow your equity in real estate. You might be able to get a rental property now or in the future without debt on it. And of course, the 1031, what most people don't understand, it creates a lot more economic commerce because it provides an incentive for someone to let go of a property. If sellers had no incentive to sell and they would only pay taxes, there might be a lot less transactions in the investment world. Understanding your tax liability. So that's the thing we want to talk about. Here's the disclaimer. Talk to your tax professional because your tax scenario is different. It's not a universal thing. It's personal depending on your circumstances. But what we'll explain here is taxes you pay on real estate, your annual property taxes to your county that's supporting your local schools, paying your way in the county, income taxes on your rental income if it's an investment property, and then capital gains when you sell. Capital gains, to those of you who don't understand investments or investment property, might sound like a scary word. It means you've made money on a property. Capital gains can be the biggest impact you have in taxes on real estate. Any other tax related to your rental property. However, it's only taxable if you actually have made a gain on your property. Understanding what a gain is, a gain takes place when you sell an investment property for more than you paid. So here's an example using round numbers. You bought a house for $100,000, then you sold it years later for $200,000. $100,000 is your basis, and your gain is whatever money you made above that basis amount, minus selling expenses. If you paid a commission, maybe you made some improvements to the house. In that example, $200,000 sale over $100,000 would be your gain over your original purchase price. Now, here's what we're going to give you a brief idea of what these percentages of capital gains are. I want you to know this is 2024. I'm recording this on March 26, 2024. This will change. If you found this video after 2024, be sure to check where these are at that time because they will change. But what you want to understand is, depending on your filing status, married or single, if you make below $47,000 as a single person or up to 94 jointly, you're not going to be subject to these capital gains in 2024. However, once you start to get above 48,000 and 94,000 as joint or single filing status, you're going to start to look at 15%. And then you're going to go over 20% when you get to a bigger number, now over $500,000 right there, 518, 583. So essentially taxes per $100,000 of gain, $15,000, $20,000. A couple of things to note right now. This will change. Two, in 2024 and for the last several years, historically, these have been pretty low capital gains tax. Check with your tax professional and know that if you're not looking at this in 2024, that's going to change. General rules in the 1031, you need to, one, plan it before you sell the property. That's a thing people do. They often get out in front of their skis a little bit. They get a contract and they don't have a plan in place. You need to have a contract that has a 1031 clause in it right there, the red letter, 1031 clause. We'll cover that in a second. That needs to be in your contract when you sell a property and when you buy a property. Then you must use, this is going to be one of the key terms, a qualified intermediary to hold your proceeds or the money from your sale. We're also going to call that a QI. Then you must identify. So right now, let's just back up. Clause in the contract to sell, using a qualified intermediary to hold the money. And then you must identify a property to purchase within 45 days of selling your property. And then you must buy that property that you've identified within 180 days of the close or whenever you're filing your tax return. Now, one of the things to note is you can start looking for a property before you close. You can start looking for a property before you even put a contract on your sale, because you can sometimes tie a property up, then choose to sell your property. Remember these key parts. One, plan ahead. Have a 1031 clause in both contracts. Use a qualified intermediary. That's a big thing people do not do. We're going to go over that in a second. 45 days to find a property, 180 days to close a property. A few more details. Plan your sale. If you have a certified professional accountant, please talk to your CPA. I am not one. I understand the real estate side of this. We can give you a lot of great information, but you need to talk to your tax professional. Talk to your real estate agent as well, because you want to understand a value and you want to get an idea of market time. If this is going to be a really quick sale that you think you're going to get a buyer quickly, that's going to impact things. Go ahead and look for a new property even before you find the buyer. You know, that's a good thing. You might be able to find something off market and kind of reach an agreement with that seller. And once you find a contract, you can move forward. Look for your QI or your qualified intermediary. Folks, in most places, state of Georgia, this is generally going to be a law firm. It's going to be a lawyer. Atlanta Deferred Exchange is a very good company. We have somebody here in town that we recommend a lot in Athens, Georgia, but that's really what that is. And then the legal clause in each contract, hit pause right now. You can steal this from us. This is one we use. You can just pause right now and you'll be able to see it. But what it says is seller may, in seller's sole discretion, elect to treat this transaction as a tax deferred exchange pursuant to Section 1031 of the Internal Revenue Code. Buyer agrees to cooperate with seller and shall execute any and all documentation necessary to facilitate a tax deferred exchange under IRS Code 1031. Provided, however, any such documentation shall provide the seller pay all expenses in accomplishing the exchange. That's your moment right here. Go ahead and pause, and that's what you can put in your contract. If you're a buyer, on the buy side, you're just going to change the seller and buyer in different parts. This is a little bit of a guideline so you understand where the money flows from your sale to your new purchase. Qualified intermediary, we've called it QI. That's the acronym you're going to want to remember. Your CPA, attorney, or realtor can recommend a good one to you, and your QI must hold the proceeds without the money hitting your account. Big thing to understand. Once the money is in your hands or in your checking account, taxable event. You don't want to touch these proceeds. They must flow as shown below. And right there in the red, the money never touches your hands. So your 1031 proceeds from selling, they go to the closing attorney's trust account where he's facilitating that sale. Instead of giving you that money, closing attorney sends it to the qualified intermediary. The QI is going to hold it there in his account. Then when you have a property to buy, closing attorney is going to receive it in his trust account, and then he's going to use that money as funds to give to the seller when you purchase. And so essentially that money went from your sale into a trust account and wound up in someone else's hands when you bought the property. Didn't touch yours. That's the other thing. Biggest rule to know and understand outside of not touching the money, you must buy as the same person or LLC as you sold to qualify. By purchasing in the same name or entity, the process is much simpler. So if you're selling in your name or my name. If I'm selling as Scott, the new contract has to say Scott. If I had an LLC that's called 123 LLC, I need to sell in that name, and then I need to purchase in the exact same entity. Really simple concept, but it's a lot of times where people make a big mistake. Now we'll look here. What if you don't want to do that? What are your options? Well, option one, you have what's called the drop swap 1031. And when to use a drop swap. This is just kind of a term that people use. An example would be when you're a partner in a property and you want to sell and to do a 1031, but your partner or partners want to sell and pay the taxes. So what do? You own it together in one name, but you both want to do different things. So before selling the property, change your LLC or partnership to joint tenants in common with a separate and divided interest. So you would go from 123 LLC as an example to Scott and John as two people owning the property in two separate names. You file a letter or have your CPA file a letter with the IRS through your QI or CPA that states you are now tenants in common and you do not want to be taxed as a partnership. 3, find a buyer for your property and divide the proceeds as tenants in common with the intent of a 1031 outlined for the one person that's seeking to do one. For the person that's paying the taxes, you don't need it. Option 2, sell single and buy as an LLC. This is an easy way to do it because sometimes people buy a property they didn't intend to be an investment and it turns that way. So if you bought a property in your own name, but now you want to create an LLC to remove some liability, there's a couple things you can do. One, you could treat it like a drop swap and deed it to an LLC before selling. So you bought a property 10 years ago, it became a rental property. So you can go ahead and you could deed that to your new LLC and then sell and then buy in the same name. Other thing people don't realize, you could also sell in your own name, then purchase in your own name, pay the taxes defer the taxes, and then you could also create an LLC after the fact. It can become an issue with husbands and wives when maybe one person in the marriage bought a property single and then they got married and then down the road, investment property. Great to talk with your CPA, but you have options for these properties that didn't start off as an investment property. Some real life examples. We've been here about 12 minutes. I promised you a truncated version of this so you could get some quick information and have this as a resource on our website. And of course, find us on YouTube. Real life example. Why do people do this? Well, this has happened to me several times. And here's a more recent example that also outlines one that just happened 4 years ago. So I could reuse the same example. Client A, man has a low basis. He's owned the property almost 20 years, does not really feel like paying all these taxes right now. So he's not been a seller for many years due to the taxes. A new opportunity emerges to buy a business opportunity here in town, real estate. It's actually real estate. It's not a business. Keep in mind, like-kind exchange, but reinvesting for his commercial business. And then now this person is incentivized to sell this property. So now he has a place to put the money and defer the taxes. Client B, low on cash, but high on equity. Here's another example. They want to improve their investments for retirement. So they don't have a lot of money to go put down payments on new properties. But what they can do, if they have one investment property, for instance, $100,000 gain in 2 smaller investment properties, they can leverage that into reinvesting. Now, this person can use the 1031 to buy client A's better and larger investment property. So what I want you to understand there, client A now incentivized, was not incentivized because of paying taxes, has a place to put that money. Client A is now interested in selling. Client B would love to have client A's property, but doesn't have the cash to purchase it. But they do own investment property that they can sell and reinvest into client A's property. That's a perfect example of how it also creates more commerce. Without this incentive, client A is just going to hold on to this property. They're going to collect their rent, may even pass it down. They may die owning that property. And that takes away opportunities for other people in the future. Now, types of 1031 exchanges, won't spend too much time here. Number 1, forward exchange, standard exchange. That's the one we've gone through. That's the one we've explained. There are 2 others that you might want to look up. I'm happy to talk to you a little bit more in detail about them, but I don't want to spend too much time. There is the reverse exchange, which is when you buy before you sell. Way more complicated than what we've already gone over. And there is a construction exchange. But the first one above is exactly what we talked about in depth. The other 2 are more complex and have different methods to accomplish the exchange. The construction exchange, just a quick note, you can use this to buy a property in need of work or to build a building. It's more complex, but very doable. The key is always not touching the money. A third party has to be brought in as what is called a holding party or a title holder. Money must be handled properly for any work to be completed. It's much more complex. It is out there. There is such thing as a construction exchange. What I've always said, talk to your CPA and your real estate professional. One thing I want to note, I've done this 15 minutes. It's half the time of the other one. Not every real estate professional is equipped to help you with this. Just know that. That doesn't mean that they're not a great realtor or great real estate professional, but they might work solely in the residential market. They might not have any experience with it. And if you use an inexperienced person with an investment property or 1031, you're bringing some liability in there. You need to be working with someone that knows what they're doing to kind of help you with the pitfalls. There's a lot of times people put down earnest money and they forget about maybe making a change to the contract to where that earnest money can be taken out and using more proceeds to avoid more tax liability. So let's just show you the simple roadmap. We're going to end here. This is just kind of quickly here. This is the simple steps. Don't be intimidated by it. It can be done. You do need one, plan your 1031 sale, line up a real estate professional and call your CPA. Those are the things. That's how you plan it. Real estate professional, how much is it going to be worth, and what CPA I need to check with you. Most CPAs are going to tell you, hey, you can pay your taxes now, but if you want to reinvest, that's one thing you can do. Line up your QI, your qualified intermediary. Use the 1031 clause in the contract when selling. Hold the sale proceeds with that QI and identify any possible new properties within 45 days of closing the sale. Remember, when you find a buyer, you can start looking then, but the clock starts ticking when you close the property, 45 days. Secure a contract to buy one of the identified properties because you can identify more than one. And then with the 1031 clause in the contract, remember you had the clause in the sale of your property, now you're putting it in the purchase contract. And then close on the 1031 property within 180 days using the proceeds that are sent from that qualified intermediary's account. And that's where your funds were held because you never touched them. And that's going to help you get this 1031 done. That's it. About 17 minutes here. Send us, this actually, this is an old slide, so sorry to end it this way, but 3 ways to kind of follow us or stay in contact with us. One, website, 5mrealty.com. You might have seen this there. You can also email us, info@5mrealty. Also, my email is scott@5mrealty as the broker, but info will go to us as well. And if you're watching this on YouTube or possibly even our website, click subscribe. You can find us on our YouTube channel. We have videos on market updates. We will have property videos for new listings. And from time to time, we're going to have videos like this that might give you information. Number one, investment properties, 1031 exchange, possibly condos in the area, residential homes, what you need to know in the real estate world that's happening right now that might be something to help you, even if you're not planning to sell or purchase. It might help you make a decision about a property you own. Thanks for staying with me for what is now almost 18 minutes. Again, if you have any questions about 1031 exchange, investment property in Athens, Georgia, reach out to us, info@5mrealty, or just click subscribe.